So let's get into 1/1 now. You're starting to hear hard market, if you wish. But Dan, I'll start with you. How do you see the reinsurance pricing picture shaping up? As we're going into 1/1 and then 2021, whatever you want to. How do you see it right now?
Sure. You look at the dashboard and you see green all across. I mean, the needles are pointing to, as I said earlier, uncertainty is higher. Price of risk goes up if investors want to return and your investment income prospects are vastly truncated compared to historically. COVID is going to impact us in ways that we're still figuring out. And you have a drumbeat of losses on a day-to-day. That points, in my mind, to a higher cost of risk. And we're a small player in the global market, so we're not going to move the market. What we can do is say where we feel we're getting paid an adequate return, we'll be committing our capital. I think the head when people talk about rates, they generally gravitate to the property cat market, and I think that our view on that is changing, and that if you asked me a month ago, we would have said, the 1/1/2020 renewal was probably a damp squib, as the British would say, except for the retro space. So the retro market repriced. The big four kept the lid on rate increases and around the world. But then as you rotated into Japan, which saw big rate increases, you rotated to Florida, those rate increases came down the pike. We would have thought, retro having repriced itself, probably not a big move, and we might even be looking to move some capacity out of retro into the underlying cat reinsurance business. The early indicators are with the uncertainty around availability of collateral due to COVID, COVID triggering a trapping of collateral, that there's going to be a restructuring and another repricing on retro. So that's the spot that I'm the most interested in watching. And then as a bit of a sideshow for us, at least, watching what happens in Europe and what the big European reinsurers are going to be doing at the renewals with their clients.
No, retro is a big, huge cloud, if you wish. So anyone else want to hop in on? Evan, why don't you give me your take, if you don't mind, on what you're seeing now moving into fourth quarter here and pricing, and if you want to dive into retro as well, because it's a big.
Well, every indication that we're seeing is the market's going to continue to harden. We, as a MGU and a platform and an underwriter, we're not bearing risk right now, so we're constantly, a big part of what I do is I'm on the phone with a panel of traditional and alternative insurers and reinsurers, and all indications I'm seeing are rates are going to continue to harden on that.
Yep.
And then on the retro space also, being what's called a parametric provider, the retro market is something that we do participate in. It's when people are calling us, it's because there's challenges. It's more of an opportunistic type thing. And our phone is starting to ring on retro opportunities, whereas 2-3 years ago, when there was plentiful UNL capacity, we weren't getting these phone calls. So it's just a state of what's going on in the market, or sign of what's going on in the market.
Although I would have a question, Tom, for the panelists, particularly I think for Dan and Maamoun specifically. As you think about the economic challenge that a lot of customers are going to face, whether they are a carrier customer or an MGA customer, premiums are likely going to be down because of the exposures being down. There's going to be more pressure on the combined ratios. I think the latest estimate is that the industry combined is going to be well north of 100. What about the capability or willingness to pay and continue these rate increases? This will be the third year, I believe, that we'll see potentially a double-digit rate increase. Where do you see that sort of tipping point? Do you see that rate actually materializing, or do you see that rate coming in more in higher deductibles and people deciding to form their own captives?
Yeah, I'm happy to give some thoughts on this, Marie. I think that is a very important point that you bring up, and I think the importance and the resiliency of our product is it does have premium adjustment features to it, right? So it is tuned to economic activity in many ways and how we charge premium. And I think we have to be thoughtful about ultimately the end consumer whatever we do has to be good for the end consumer. It has to work for the end consumer. And so I think inherently in the product, there's a fix there. And then as we go through this, I mean, clearly this consumer protectionism, rightly so, that's on the fore of governments globally, will be also another opportunity for dialogue and collaboration in how we go through this. But I think, the thing that I want to step back from in the comments that, Evan and Dan made, and I agree directionally with what they've said, is to add that, COVID is a critical component to what's happening at 1/1, but it's not the only component, right? I mean, if we think about just interest rates in the United States alone, we just think about that scenario for anything that has duration in it. And let's not forget, as an industry, insurance and reinsurers count on investment returns as a component of the total return. Whether you're in risk-free or high yields or whatever you invest in, it is an important component of what you do. And so the spreads in the United States today are the lowest they've been in 57 years. Mm-hmm. We've lost, 150 basis points in the last 2 years, 300 basis points in the last 5 years. And that is crucial when you talk about products that are 4 or 5 year durations. And to make that up in our business is difficult. Mm-hmm. And so I think I put that, right next to, if not even more, critically than COVID in terms of how we have to think about the margins and the returns that we can produce on our capital going forward. Not to mention, the thing that Dan talked a lot about was the frequency of cat events, the frequency and severity of cat events. There is certainly, I won't go into the climate change debate, but there is definitely something observable in the last 3 years that is not in dispute as far as I'm concerned. And so the interesting thing here for me is, as we talked about, Tom, when you started the conversation at the beginning of the call, we talked about just how employees and clients and so on faced COVID differently, right? I think what's going to be really interesting at 1/1 is there's going to be diversity in views of risks and risk tolerances in the industry. Right. And how deals clear at 1/1 won't be the same old sort of views that we've been accustomed to in the last couple of years. There'll be people that are tolerant to, certain classes of risk more so than others, and I think that's positive. That's what makes a market. And so all that adds just to the whole uncertainty beyond the direction of rates, just the whole uncertainty of how the deals couple together, at 1/1 and beyond.
I think that's an excellent point, Mamoon. I mean, are people going to be dogmatic? I mean, we observed at July 1, there was no market consensus that we were taking a view in certain areas that we needed changes in coverage in terms and conditions to make us comfortable go forward. And almost universally, we got what we were looking for, but it was not a contractual change. It appeared on our I&L. So that was interesting in that at July 1, there were some people who hadn't gotten a message from home office or hadn't determined on their own that they wanted to make changes. So it was status quo. But I get a sense that at least the posturing is that there's going to be changes coming down. And therein lies an interesting opportunity, because if you do all, if all you have is a hammer, everything looks like a nail. So, you're out there banging away, and somebody's saying, well, I'm actually not a nail, I'm a screw. So, I want to have a discussion about that. So, there's going to, I'd imagine the pendulum swinging. There's going to be lots of discussions that are foreshortened by, I'm sorry, that's what my boss tells me. But at a time when we really all want to be leaning forward and listening, like, is this exclusion appropriate for my line of business? What are you intending when you put this in? Are you intending to, if my insured has COVID, does that mean he doesn't get coverage in the event his house burns down? And those are the sorts of discussions that we want to have. One of the things I would raise is that we have a generation of brokers and underwriters who haven't really had a chance to have those discussions. So there's been a sort of systemic downward grinding of the market. And if you raised your hand and said, I'm a screw, not a nail, you got hit in the head anyway. So, what I've been telling my team, and most of them we all cringe with seasoned veterans. This isn't your first hard market rodeo, so let's keep the dialogue going. Let's encourage the brokers to talk to their clients. Let's get the clients' feedback. Renewals expiring left 10 for the same coverage ain't going to happen, but what might happen? One of the things that I don't like is our industry is famous for underpricing risk, and then you have price discovery, and then they run away from the risk. It's like, Mamoon has the same DNA, I think, that I do on some sense. You're drawn toward the fire. Let's figure out how we manage it. What's the opportunity there, as opposed to there's oh my God, I screwed up and I never want to do that again. So.
Right. No. And we'll get into that too, because there's a lot of that, data analytics and, are there new tools that underwriters are using? And we'll finish up on that area. But
Tom, the beauty of it is if you've been around long enough, you dust off an old tool, it looks like a new tool to somebody.
The old rating books, are they coming off the shelves? Are we dusting those things off?